Hello again and welcome back to another session of Commerce class with me, Suman Rathore. Students, we have already covered the straight line method and the written down value method of depreciation in our previous videos. Now, there are two cases for depreciation. First, where provision for depreciation account is not maintained, and second, where provision for depreciation account is maintained. Now, case first, where provision for depreciation account is not maintained, in that case, depreciation is credited to the asset account like we were doing in our previous videos. But in second case, where provision for depreciation account is maintained, in that case, depreciation is credited to the provision for depreciation account and asset account will appear at its original cost. Now, the balance on the credit side of provision for depreciation account shows the accumulated depreciation till date. And when the asset is disposed of or sold, that accumulated depreciation will be transferred on the credit side of the asset account. Now, to understand the concept better, let's take a practical question. And for this, I am taking this practical question from Arya Publications Goyal and Goyal, Practical Problems, question number 26. Now it says, a company purchased second-hand machinery on 1st May 2009 for 5,85,000 and immediately spent rupees 15,000 on its erection. On 1st October 2010, it purchased another machine for rupees 4 lakh. On 31st July 2011, it sold off the first machine for rupees 2,50,000 and bought another for 4,20,000. On 1st November 2012, the second machine was also sold off for rupees 3 lakh. Depreciation was provided on the machinery at 15% per annum on equal installment method, which is our straight line method. Show the machinery account and provision for depreciation account assuming that the books are closed on 31st March every year. So here I am making provision for depreciation account and machinery account simultaneously because it is very convenient and easily understandable. So let's start doing it. Now, as I told you earlier that the machinery account will appear at its original cost. So the entry of purchase of machinery will be made here like date 2009, 1st May to bank. And rupees 5,85,000 is the cost of machine. Then rupees 15,000 spent on its erection on the same date. So to bank date will be same and 15,000 here. Now the books of account are closed on 31st March every year. So 31st March by balance carried down and the amount is 6 lakhs, right? Now this balance will be transferred here on 2010 April 1st, right? To balance brought down this 6 lakhs here. Now the entry of depreciation, and depreciation entry will be credited to the provision for depreciation account, right? So the depreciation will be charged for 11 months only. So it will be like by depreciation 31st March 2010 and the amount 6 lakhs 15% comes to 90,000. But here we have to charge depreciation for 11 months only as the machinery was purchased on 1st May. So from 1st May to 31st March is 11 months. So 11 months depreciation comes to 82,500, right? Now this depreciation, again we have to balance the account. So now it says on 1st October 2010, it purchased another machine for rupees 4 lakh. So let's make entry of that now. On 1st October 2010 to bank, this is our machinery 2 amount is 4 lakh. Now time to close the account and balance the account. By balance carried down 2010 31st March. 10 lakhs, right? Now this closing balance will become the opening balance of 2011 April 1st to balance brought down 10 lakhs, right? Now let's see the entry of depreciation. Now as depreciation is provided on the last date of the year, so it's March 31st 2011, by depreciation on machinery first. Now this time on this first machinery, whole 12 months depreciation will be provided at the rate of 15%. So 15% of 6 lakh comes to 90,000. And on the second machinery, as it was purchased on 1st October, so only 6 months depreciation will be provided from 1st October to 31st March. So 4 lakhs 15% comes to 60,000 and 6 months depreciation will be 30,000. So by depreciation machinery to 30,000. Now March 31st. Now again close the account and transfer the balance. Now it says on 31st July 2011 it sold off the first machinery and for 2,50,000 and bought another machinery for 4,20,000. So let's make the entry of that third machinery first. So on 31st July 2011, date will be 2011 July 31st, to bank 4,20,000. So here it will be okay. Now let's do the entry of sale. But before that, we have to make depreciations entry on that first machinery for 4 months from 1st April to 31st July, 4 months. Okay, so here July 1st by depreciation on machinery first for 4 months only. I'm writing it here like this. Okay, so 4 months depreciation on this 6 lakh machinery comes to 30,000. Okay, now let's see the rough note or working note and write it like machinery 1. Okay, here the cost of machinery is 6 lakh, right? And the depreciation first year it was 82,500, right? Then second year whole 12 months depreciation was 90,000. And third year, the year of sale of machinery, only 4 months depreciation was provided, which was 30,000, right? So the accumulated depreciation on this machinery is 2,25,000. Now this depreciation will be deducted from this cost to know the actual value of machinery on the date of sale. Okay, so the actual value of machinery is 3,97,500. Now the machinery was sold for 2,50,000, right? Now you can clearly see that it is a loss on sale of machinery, which is 1,47,500. So this is our loss on sale of machinery. So now let's transfer the amount in our account. So it's 2011 July 1st by bank machinery was sold for 2,50,000. So it's 2,50,000 here. Then on this machinery, accumulated depreciation that we have calculated there in our provision for depreciation account comes to, by provision for depreciation, 2,500. And the loss on sale of machinery will be transferred to the statement of P&L. Okay, so the loss on sale of machinery, which is 1,47,500. It's here. Okay, now again it's time to balance the account and transfer the amount. So it's 2012, 31st March, 14,20,000. So to make it 14,20,000, 8,20,000 will be added here. Okay, and then transfer the balance. So 2012 April 1st to balance brought down 8,20,000. Now it's time to provide depreciation on remaining machineries on machinery 2 and machinery 3, as machinery 1 is already sold off. Okay, so 2012 31st March, by depreciation on machinery 2. Now this time whole 12 months depreciation will be provided on this machinery 2. Okay, so 15% of 4 lakh comes to 60,000, right? And for machinery 3, only 8 months depreciation will be provided as it was purchased on 31st July. So 8 months depreciation comes to 42,000. Now again balance the account and transfer the amount. Okay, so it is 33,4500 here, and to balance carried down 13. Now it says on 1st November 2012 the second machine was sold for rupees 3 lakh. So let's make the entry of sale of machinery and depreciation on that machinery. So the depreciation on this machinery, second machinery, this time will be provided for 7 months only, as it is sold on 1st November. Okay, so 7 months depreciation on this machinery comes to 35,000. Now for accumulated depreciation on the second machinery and profit or loss on sale of this second machinery, let's see the working note and write it like machinery 2. Okay, so here the cost of machinery is 4 lakhs, right? And the cumulative depreciation on this machinery, first year only 6 months depreciation was provided on this machinery, which was 30,000. Then second year whole 12 months depreciation was provided, which was 60,000. And in the third year only 7 months depreciation was provided, which was 35,000. Now the accumulated depreciation on this machinery is 1,25,000, right? Now we will deduct this depreciation from the cost of machinery. So let's write like less depreciation 1,25,000 to know the actual value of machinery on the date of the sale. So it was 2,75,000. But the machinery was sold for rupees 3 lakhs. Okay. Now you can see here that it is a gain of rupees 25,000, right? So now let's transfer the amounts. So it's 2012 November 1st by bank. Amount machinery was sold for 3 lakhs. So the amount is 3 lakhs here. Then provision for depreciation. For depreciation, accumulated depreciation is 1,25,000. Now the profit on sale of machinery that we have calculated in our working note will come here on the debit side, as it is profit. So statement of P&L, and in brackets let's write profit, and the profit is 25,000, right? Now time to balance the account and close the account. So 2013 31st March by balance carried down, and the amount is 8,45,000 on this side and to make it 8,45,000 on this side, we have to add 4,20,000, which is our balancing figure. So now our machinery account is closed. Now it's time to provide for depreciation on our machinery 3. So here is 2013, March 31st, and this time whole 12 months depreciation will be provided on machinery 3. So 12 months depreciation on this 4,20,000 comes to 63,000. The accumulated depreciation on our machinery 2 was 1,25,000. Right, so let's write that also here, November 1st. Okay, now it's time to balance the account and close the account. So let's do that. 2013, March 31st to balance carried down. Now let's see, it's 2,30,000 this side, and to make 2,30,000 this side, we have to add 1,05,000, right? So it's 2,30,000 here also. So this is how we prepare provision for depreciation account and machinery account. That's all for today. Thanks for staying in tune, and don't forget to like and subscribe my channel. Thank you and goodbye for now.